high growth area. But we love it here in Texas, and we're really excited about what's happening here, and happy to help folks on this call and talk about real estate and residential real estate and what's going on with the pandemic that we are in right now.
Excellent. Well, Marshall, I really appreciate your time. Thank you for that background. And then finally, we have Cherie Crosby Wheeler. Cherie is a VP of Corporate Responsibility at Mr. Cooper here in Dallas, and is also the DFW Emory Alumni President. Cherie, you could say a few words, please.
Cherie, you're muted.
I know.
All right, there we go.
There you go. There you go.
I just saw the little thing pop up and say, hey, you're muted. I'm like, what's going on? I just started talking. Like I was saying, I am Cherie Crosby Wheeler. I am the president of the Dallas chapter. What a year to be president. I had all these plans. And so, you know, things change as we're going through this global pandemic. I work at Mr. Cooper, which is a mortgage servicing company, and we are the largest non-bank servicer in the country. And I just want to share a little bit about what we are seeing with respect to helping homeowners out. And I'm happy to be on this webinar, and thankful for everyone joining us today to talk about this topic.
Yeah, and Cherie, thank you so much for joining us. Cherie is a wealth of knowledge, and when it comes to mortgages and the mortgage industry. So really appreciate your time. Thank you. All right, perfect. So Jacob, let's go ahead and let's talk about where we've been this year. So if you wouldn't mind pulling up the Buying and Selling Real Estate in a Global Pandemic document there. And Jacob, if you can't do that, I've got it myself. Oh, here we go. There we go. All right, perfect. So really appreciate that. So where we've been, so on March 3rd, the Federal Reserve. So the Federal Reserve, it is the body that makes policy, monetary policy in the US. They meet quarterly, and on March 3rd, ahead of the meeting, there was a surprise move. So they cut the benchmark interest rate by 50 basis points. So this was unprecedented, and what happened is it actually triggered a refinance surge, right? So the rates on the 30-year fixed, they dropped from the 5s and the 4s down to 3s, and volume spiked overnight. We were all inundated with applications across the board, from conforming loans to government loans, so FHA, VA loans, as well as jumbo. And the reason why we did not necessarily see the challenges that we've had over the past couple months has primarily been because at that time, it was really a Asian pandemic, right? So it hadn't really hit Europe at that point, and it definitely didn't hit the US. There were very few cases of COVID-19 in the US at this time. The reason why it's triggered this surge is because they saw that global growth was going to be affected, and it was going to impact stocks as well as the overall market. So the Fed got ahead of it, cut its benchmark. So when we do a transaction, we do a mortgage transaction, there's two sides, and these are called counterparties. So when I originate a mortgage and when I lock in a rate, there's an investor on the other side. They actually purchase my loan, right? So they'll go ahead, they'll purchase it, and then they'll put that in a portfolio, and then they'll securitize it, or it'll just sit on their books. Now, when you have a surge in new applications and investors are using up all of their capital, because they're the ones that are buying it. So when you have a situation where it's 192% up for the year, and in 1 week it was actually up 500% compared to the year before, what happens is the investors, they've used up all their capital and they run dry. So normal markets, you have the Federal Reserve and you have the banking system. They facilitate mortgage purchases and they provide that liquidity so that we can consistently and continually originate mortgages. Well, what was happening is because of the refinance boom, you had what was going on in the market, and there just was not enough liquidity. So the Fed said, okay, we have to go further. And we also saw the coronavirus pandemic really starting to enter Europe. And we knew that it was starting to show up in Seattle and Los Angeles and New York and other markets. So after dropping the Fed funds rate by 50 basis points, they cut it all the way down to 0, right, on March 15th. So they went from 1.75 all the way to 0 within a month, which was incredible, absolutely incredible. So at that point, because of the large decrease, and it was, it was certainly celebrated by the president. So POTUS said, yes, that's what the Fed should have been doing all along. Well, the stock market crashed, and investors, they got the signal that this was no longer a regional issue. This was a global pandemic, and it was going to affect everybody, and it was going to affect the growth of the overall market. And, just so people understand, the stock market isn't just this being that hovers and it goes up and down. It is a composite, right? So when you look at the Dow Jones, it's actually made up of 30 different companies that make up a representation of the overall market. So when you look at a stock and you price that stock at a particular level, and you have a forecast that that particular stock is worth, say, $50, well, if you have a slowdown and it's cutting across all these areas, they now say, well, I don't think that stock is worth $50, so I'm going to sell it. So that's what happened. That's why the market goes down. So just a little bit of FYI there. So we've got what's going on where you've got rates down to 0, the Fed funds rate, right? So I believe me, I got plenty of phone calls where people said, can I get my 0% mortgage? No, you can't get a 0% mortgage. It doesn't exist. But it was certainly entertaining that week, to say the least. So now, 2 weeks after this, right? So now Congress passes the CARES Act, and they enact a $2 trillion stimulus package. And it provides much needed relief to businesses and families, right? So it helps small businesses with PPP loans and the EIDL loans. It also helps people where they got their stimulus check, $1,200 or $2,400, and with children a little bit more than that for people that make under a certain amount. In addition to that, the government declared that homeowners could elect forbearance. So what they did is they put a moratorium on foreclosures. So if you think about 2008, so for those that were in the industry or just remember 2008, what you had is you had all of these banks that were failing, and the only way to save the economy, the government sent all of this money and propped up the banks, right? So they had this big stimulus package, it went to the banks, and the moral hazard was really on the banks themselves, because they didn't have the safeguards that said you must lend this out to certain amounts of people. I mean, the banks certainly tried, and they said, well, if they don't have their job, I can't qualify them, so I guess we're in trouble, and we're not going to be able to do those loans. Well, what had happened is if people can't make their mortgage, they simply stop paying. They immediately went into forbearance, and at that time, we had a market where in 2008, it was a very large surplus of homes. So a lot of what we're going to be talking about today is supply and demand. It's basic economics. So when you've got a large supply of homes that are on the market in 2008, and then you add in the fact that demand goes down because no one can afford to buy these homes, you have a crash. And that's why you saw real estate crash in 2008. Now, what's happening now is you have the Treasury Secretary, Steve Mnuchin. He has already seen that story. So he knows that we can't have a crash. We can't have housing fall to the ground. So we're going to have this moratorium and allow people, instead of going into foreclosure, we're going to allow them to call their mortgage servicer and elect forbearance, which allows them to just put a pause on their overall mortgage payments. Now, as Cherie is going to talk about today, it's not a mortgage vacation. It's not just a smart, savvy idea. It is a last resort when it comes to right before foreclosure. But because these people have not gone into foreclosure, it's actually helped the market, and we're at a very low inventory type market. So that's why prices have actually held pretty steady. Now, here's another piece to this. Loan servicers, they're on the hook, right? So Mr. Cooper is, Cherie works for Mr. Cooper. They are on the hook to pay whoever it is on the other side, the investor, the mortgage payment, right? And the government, they just talked about this. They said, okay, we're going to allow these servicers, as long as, we're going to make sure you're going to have to pay all of those mortgage payments if your clients aren't making those payments, but we'll pay it past 5 months, right? So you have to make sure that particular servicer, they're well capitalized and they're able to make all those payments. Some are not, and what you have is this current lending climate where you've got the most support at the conventional level. So these are Fannie and Freddie, where you're getting still low to mid threes for a 30-year fix with good credit. So that's in Texas and most states, it's $510,400 MO, so that's the conforming loan limit. And then you also have where Justin is, where you have high balance counties like Los Angeles and Orange County, where the limit is 765, 600 and below. And then also government loans. Now, where it's really tightened up has been the jumbo side. So those jumbo lenders, they're concerned because people have been, enacting this forbearance and it's affecting their ability to lend. So what's happened is you now see higher credit standards. So we're talking about 700 plus FICO, increased reserves. So that means you have to have money in the bank and not just money, actual cash, right? So you have to have liquid reserves. Also, they're saying that we won't let you lend at higher debt to income ratios. So the qualifications are lower debt to income ratios, and then also increasing down payments. And if you want to try to get an investment property at this time, it's very difficult. Now, for those that have heard of non-QM or portfolio loans or hard money, that's another term that a lot of people have heard, those have mostly evaporated. So these would be for national lending, bank statement loans, asset depletion, debt service, coverage ratio loans, where it's a loan where you're renting on, you're lending on an investment property and you are actually qualifying them off of the income. And you're not even using tax returns. So all of those types of loans have essentially gone by the wayside. So where we are now is a very interesting climate. And I'm so happy to have Justin and Marshall and Cherie through this whole experience. So I'm just going to open it up to our experts here. So feel free to jump in wherever you'd like. So what's been our professionals' experience throughout COVID? So Justin, I'll let you start.
Okay, thanks, Ron. That was really great information, and thanks, Cherie. I mean, pre-corona, it was mostly an in-person business with networking events, open houses, showings, in-person meetings, inspections. Oftentimes, buyers and sellers would physically go to an escrow office to conduct final closings. And as far as just what the market was doing, the supply has been really the tightest we've seen in decades, with many homeowners having a considerable amount of equity heading into the pandemic, which was a big difference to 2008, as Ron, you had mentioned. While the first couple of months of 2020 didn't have the same buying activity as the same period in 2019, there were still many properties that were receiving multiple offers, with sellers still having leverage in price and negotiations. And I'm talking mainly about LA. So it's a lot of stuff that I address that's really market specific. As far as what is going on now, I mean, I think the biggest thing is we know the market has been told to really go to the corner and take a time out. I mean, that's what's happening. What we've been seeing is that there's no pandemic discount also, which is important to know, at least for now. There's still a lot of deals being transacted, but not to the pace of pre-corona. So sellers have to think to themselves, what is their game plan? Sellers who don't have to move will either just test the market and pull their listing if they don't get their number before actually lowering their price. And most homeowners, as different than '08, I mean, they have enough equity to sustain any of the price declines, really. And buyers on the opportunistic side, there's less competition. So if they present a clean offer with flexible terms, they could avoid a bidding war or just get a quick approval done, which would be, amazing on their side. I see like best case scenario, the busy buying season switches from traditional spring and summer to fall this year, save any new big virus spikes. But exactly when the market picks up again at a 2019 pace will really depend on infection rate trends and social distancing measures. And I mean, there's a couple of interesting sectors that are worth also watching. Office and hospitality and retail, as I'm sure we've all kind of thought about what happens in these sectors during time when everyone is staying home, not traveling, not going to different stores where they're used to going. And on the business side, as a company owner, if your business can still thrive with the greatest percentage of your workforce working from home, your incentive for big office space really decreases. The game kind of changes. And the retail companies that will really thrive, because there will be some, are the ones that have been able to pivot with doing a lot more business online and curbside, as well as really focusing their broad plan on connecting and bringing real value to their customers. And I know I've had questions a lot recently about home flipping and developers and home flippers. They have to be extra cautious right now, mainly because of their project timelines, because they've been challenged with supply chain issues and labor guidelines. But there's a way for them to succeed right now, and it's really with speed through smaller projects that are quicker to market and not buying those older properties that have a lot of unknowns attached to them. Homes should be really priced to sell, and they should have rental contingency plans as well, just in case their plan doesn't go as planned. That's my initial take, Ron.
Excellent, excellent. Marshall, I know in the DFW area, there are a lot of people actually, and definitely pre-COVID, when it comes to people that are relocating to the DFW area and being so close to DFW Airport. Tell us a little bit about what you've experienced throughout this whole period.
Yeah, thanks, Ron. Yeah, I guess the first thing that I'll say is that the experience we're seeing in Dallas right now is a little bit different than Los Angeles. And that goes to the point that real estate is really very local. So what's going on in Los Angeles or New York or Atlanta or Dallas are all going to be very different. In fact, even within a city, different towns or neighborhoods, it could be very different. So just because, Justin or I say this is happening and this is what you need, this is what you think will happen, may not necessarily be true in your case. So my advice always is to get a realtor who knows your area very well and can help you, because what's going on in your town may be very different than what we're talking about on the call. So it is very local. But here in Dallas, if you look at the end of 2019, we were really firing on all cylinders in the Dallas market. Sales were up, taking advantage of a good economy, low interest rates, and businesses moving to the Dallas area, people moving because of the cost of living and take advantage of these new jobs. We really had a pretty intensive house shortage. There wasn't enough housing to go around for everyone that was coming up. So our markets were very busy. And this was continuing into the beginning of 2020. It felt like we were already in spring and selling season back in January and February, very, very busy. In fact, in the first 3 months of 2020, sales in the Dallas area were up 9% year over year. That's a pretty big increase, year over year increase. So Dallas area was really on fire through the first couple of months when this pandemic was just beginning and we started to see the impact. So in mid-March, when the counties and the city and the state started shutting down, really the first thing that we saw was showings. People just weren't going out to show, probably because real estate wasn't necessarily essential, or wasn't sure if we could go out and show homes or not. And then a lot of people didn't want people coming into their homes. So the number of showings decreased to about 20% of what we had seen prior to the pandemic hitting the area. So we saw showings go down, and this really translated into sales coming down for April. So Dallas Morning News reported this week that the April sales of homes were down 17% year over year from last year. So that's a big, big decrease, but it really goes to the fact that people just weren't looking at homes. But between the first 3 months and then April, we're still up 1% year over year in total home sales. I think the challenge, and much like Justin said, will we see year over year increases in total number of sales homes coming out? Probably not. And I say that because inventory of homes for sale is really down, as people weren't putting their homes on the market, or they took them off the market. We are actually down in total inventory 13% from where we were this time last year. April listings were down 26%. So a lot of those homes that would have normally be coming on the market getting ready for the spring selling season just didn't happen. So we are seeing in the Dallas area, it is frantic to get a house. We are seeing multiple offers. We're seeing $15,000 bids over asking price for houses that aren't even that good. So it is definitely a challenge in your average home sales. Now, if you're in a luxury area, we're seeing kind of a different story. Home sales are down dramatically, and in Park Cities, which is probably the highest priced area of Dallas, prices were down 35% and sales were down 40%. So if you're in a high-end area, we'll definitely see the impact of the lack of funding and jumbo loans available, plus general economy conditions. People at that price point just aren't ready to buy until they feel more comfortable. So we're definitely seeing impact there. But for your average homeowner, average buyer, it's kind of a frantic market right now is what we're seeing in Dallas.
Excellent. Really appreciate that perspective. Cherie, on the mortgage servicing side of things, how has the year been? Tell us a little bit about what you're seeing.
All right. Am I unmuted this time? So to echo what everyone has been saying, everything looked fine at the beginning of the year. Obviously, we had all these plans, what we're going to do. This year is going to be great. You have your leadership conference at the beginning of the year. And then the stay-at-home orders hit, everything shuts down. What we experienced was because of the forbearance that was offered through the CARES Act at the end of March, it got bananas at our company. I mean, just the number of people that were calling in looking for assistance. And so what homeowners encountered at that time were these extremely long wait times, because obviously we weren't staffed to handle that volume. Most other companies were not either. You saw that with respect to even small business loans where systems were crashing, things of that nature, because just the volume that was coming in. So we had to quickly, pivot. And even with respect to working from home, we pivoted very quickly. We have 9,000 employees, and I think only, I want to say 300 or 400 are still in the office considered essential. So we turned really quickly. We made sure that in addition to people calling in so that they wouldn't be waiting so long, we quickly set up electronic methods for people to request forbearances, which I don't know if you want me to go into that right now more so, but that's just a snapshot of what was going on as far as it being frantic for servicers. I'm sure all servicers are just slammed because of just the impact upon so many people at the time. But I'm happy to say now that during this time even, we've been able to hire more and more people and take those wait times down. So.
Excellent. We really appreciate that. And we will have an opportunity to talk about the forbearance, because that's very important to have a discussion when it comes to helping homeowners. One question that I have for Justin and Marshall: are your clients fearful to buy or sell in this particular environment.
Marshall, you want to start?
Yeah, I think it just varies. It's all across the board. You definitely have sellers who are not comfortable putting their homes on the market and having people come through, whether they are susceptible or in a situation where they really can't risk getting sick. And so you definitely have those. And I think the challenge as a realtor is coming up with a solution for them to be able to sell their home without having a lot of people coming through their home. So I think overall, we're just not seeing very many open houses, and that may be a while before we start seeing those come back the way we used to see them. Buyers, I don't see as much fear, but wherever we go into a home, you always see a hygiene station where you'll have potentially a mask, you'll have hand sanitizer, and the sellers are requiring you to wear your mask and clean your hands whether you enter and exit the building. So there's definitely ways that people are staying and able to see homes. So buyers probably not quite as much, but usually when they're buying in a situation where they have to buy and you pretty much do what you have to do. But there are definitely probably some people sitting on the sidelines.
Yeah, that's all really great information. It's a case-by-case basis, really, I think, as Marshall had explained as well. Realtors have been able to shift how they're really doing things with virtual open houses and virtual listing presentations and buyer consultations and video first marketing. I know we're going to get into a little bit of the video marketing later, but we've just had to be smarter. Virtual tours and higher quality photography and using FaceTime and virtual staging. And from the safety side, just providing those face covers and gloves, hand sanitizer and wiping down all the surfaces and doing a really good job of spacing out showings more so people feel safe. And I know some buyers that they're going to buy without even seeing the interior, as long as the realtor does an exceptional job of creating the experience for the buyer. On the seller side, I think, some sellers won't even be allowing, I guess, buyers to even enter their home unless there's an accepted offer, which is a definite shift. And maybe that is only specific to this market. This practice is a lot more common with commercial, but it could be really adopted by the residential as well. Hopefully that answers that question.
Yeah, definitely. And, Jacob, if you could put up the minimize physical contact document there, I think there's some, I'll give a real life example of one of my clients. So a little bit of background, the borrower and buyer. So young couple, they have a newborn, and then one child is vulnerable to COVID. So they have what's known in the industry as a contingency sale. So they have a home to sell, and then they want to buy a new home. But they cannot have anybody inside their home. So this was at a kind of a low six-figure price point in terms of the home they were listing. And what they actually did is, in addition to listing their home on the MLS, they didn't have an open house. They did a virtual walkthrough, which was really only reserved for the luxury segment in the past. You would never see a $200,000, $300,000, $400,000 home that had a virtual walkthrough. And I'll show you an example of what that looks like. But now you're seeing it across the board. We actually have Betty Grant with Epic Photo Group on. I noticed she was on earlier. Her company does these, right? So they'll do drone photography, they'll take pictures of the home, and they'll get the home show ready so that people can go in and see what the home's all about and go in virtually from that standpoint. Another piece of that is only allowing accepted offers. So only if you want to visit that home and see it in person, you have to have an accepted offer, right? And they also say that when the offer, when you submit your offer and they come back and they counter, you have to agree that you've actually toured the neighborhood virtually through Google Maps. So if that you visited the various neighborhood and if you don't want the fact that there's a liquor store or a tire shop down the road, you've already indicated that is that you're okay with that. before moving forward, or during their food runs, where either to gather medical supplies or going to the bond store or whatever grocery store that you've actually toured around that particular neighborhood. Now, another big piece of this is the inspection. And I think the government and real estate professionals have done just a fantastic job in really helping people stay safe. In this particular transaction, it has been 0% physical human contact, which is just unheard of. To think that there would not be physical human contact in a real estate transaction, which is extremely touchy-feely and spending time, and as Justin and Marshall know. But with this particular couple, they did not attend the inspection in person. They did a video inspection so that when the tours came back, the inspection, they were actually the inspector who came in with gloves and booties and all of that. They were able to actually show what the home looked like from the inspection side. And then real quick, you have the government that's come in with Fannie and Freddie saying, we no longer are going to require appraisers to actually visit the house to do an appraisal. We'll allow desktop appraisals, which is incredible because now they can work from home. Everyone stays safe. They don't have to come inside the house. And if they need pictures of the home, they can get that from the actual seller, from the homeowner. And then finally, there's also been a lot of development when it comes to remote online notarization. It's a really easy acronym, Ron, but it's a guarantee rate. We call it eClose. So literally what they do is they take their ID, they meet with the notary in a webcam, show it to the screen, they verify who that person is, and they're signing loan documents from the comfort of their home. It's really incredible just what has come about in this particular industry. So I want to open that up to Marshall and Justin. You guys, talk a little bit about how you're using these new tools and what you're seeing, and a big piece. Do you see any of this continuing into the future?
Yeah, I think we're definitely starting. I'm sorry, definitely starting to see some of that. It's like each client's going to be a little bit different, and their comfort level with these sort of tools. Some people will definitely not want a contact, and some just would not know what to do if they couldn't have contact. So it's going to be a little different, but this really is pushing the industry forward just years ahead of when this would happen, really changing the way we do closings. That tradition of face-to-face celebration just isn't necessarily the way we have to do it. And it's making us really think through how the best way to do this. I've got clients that are out of town. I'm going to homes, videoing them so they don't have to go, and minimize the number of people in homes. So we're starting to see that. And then I was on a call with a big Dallas builder yesterday, and they are selling homes 100% from beginning to end to closing contactless. It's all electronic. You never have to go on site. You never have to go and be with another person, completely contactless. So it's happening, and for those who want it, it's really exciting that it's available.
Yeah, those are all great points. I think a lot has to do with where someone's personal compass is. That's really how much they feel like they are potentially living with someone who could be adversely affected if they did get COVID-19, and what kind of timeline they're really on with needing to buy or sell. But like as Marshall was saying, there's so much that we can do as realtors and support services that we don't need to really meet in person as much. And there are some unintended benefits that have come from this. It saves a lot of time. You can actually work in your sweatpants if you need to. And it's just a way that you can capture more of the day than we would have been able to otherwise. And right now it makes everyone feel safer, and that's the main priority.
Yeah, I think it's silver lining to this as real estate professional. So, me as a mortgage professional, I do loans in California and Texas, and, through my company, I can do loans in any state. I'm always operating where I'm working from my house or, with my office, but I hardly ever see my clients face to face, hardly ever, right? So if you can imagine a world where that's accepted and your value is helping that particular homeowner with the transaction and navigating all of those steps, not spending 80 plus hours with them throughout the real estate transaction, either selling their home or, hosting open houses and buyer appointments, or if you're representing them as a buyer, that you're not going to 80 different buyer appointments to show them homes. So if that's socially acceptable, that you're able to now show your value by just helping through the transaction, you can work in any state, right? That's what's really incredible, and that's why I'm pumped when it comes to realtors and really expanding and taking advantage of the opportunity that we've got. And I'm going to go ahead, Jacob, I'm going to share a screen here. So what I've got is we're going to play a little show and tell. So this is kind of fun. So everybody see that? Cool. So this is a listing. It's a modest $21.5 million home in the Malibu colony in Los Angeles. So it's a private community. And just to give you a little perspective here, this is Justin's life right here. So Justin, you live a pretty nice life. This is Malibu Beach. And as you can see,
that's my backyard right there. Thanks for mentioning it, Ron.
You got it, buddy. You got it. And we went to school right over there. So that's where we went to grad school, Pepperdine. But it, pretty incredible home. But it really gives you a sense of what the home's all about. So this is known as the technology, it's stitching. And what you do is you have a camera and you set it up and you stitch all these particular photos together. And there's software, one particular piece is called Matterport, right? So you can present this on a website and have people get a good sense of what this home's all about, right? And you get to walk around, right? So let's go to the boardroom, right? So I think it's where they have surfboards right here. So this looks like a nice little breakfast nook right next to the kitchen. You can walk through the kitchen. It's just really incredible. And, who wouldn't want the view over here, right? So let me get back into the main house. Let's see if I can drive properly. Well, this is another sitting room. That's pretty impressive. So let's go over here. So, all right, so this is the backyard. Not bad. You've got a pool here. You've got a little place here where you can, have a little breakfast, have some cocktails, and then you're able to walk people through. So, just imagine being a realtor and showing your clients in this environment. So just like we're doing right now, you have it on a Zoom conference call where you have the clients and you show multiple, just multiple slides and you show multiple properties. Well, now you're really getting a good sense. And, based on the drone photography, based on the Google Maps, you can have that conversation. So even though you may not be able to visit with the particular client in person, or it's just super awkward where everyone's wearing masks and people's glasses are fogging up. I know that's an issue that I've been having because of the mask. This is a way that you can comfortably show in an elegant way of what real estate looks like. So I just wanted to share that really quick. So Jacob, can you put up the slide that talks about the post-COVID sweet spot? And if you could go to page 2, that'd be really great. So if you can scroll down, go to page 2, and then just pull up that post-COVID home buyer. So now I want to talk a little bit about, okay, so we know that there's going to be people that are going to fall into different categories. And I think what's really key is creating a comfortable experience for people, right? So you're going to have people that are on both sides of the spectrum. You're going to have people that are, they can't open the country fast enough and they think that COVID-19 is a hoax, right? So you have those. And then you also have people that, whether it's a real medical challenge where they can't they have to implement social distancing and they have to shelter in place, or they just are scared, right? And then you have the folks that are in the middle that will wear their masks and they'll sanitize their hands till they're completely chapped, but they still value the fact that people are thinking about a procedure where they feel comfortable in the process, right? I got my haircut finally, my my biannual haircut today. And as soon as I walked in, they took my temperature. They had gloves. They gave me hand sanitizer. They made me fill out a form indicating if I, if I had COVID or any of my family members, or if I was sick or anything like that. And then the person who was cutting my hair, the stylist, they had a mask on. They had gloves. I felt comfortable in the process, right? And that's what's really key. Now, think about the fact that for the past 2 months, you are sitting with either yourself or your partner or family, and you've been staring at those 4 walls. And either consciously or subconsciously, you're going to make a decision, right? And if you like what you see, then great. Maybe you do a couple of home improvement projects here and there, but if you don't, you're going to make some changes. So I'm going to start with you, Justin. Let's talk about first-time home buyers, right? So let's talk about first-time home buyers and then young families. What we're talking about here is renters that see the lower rates and they want to go out and they want to buy a home for the first time, and then also young families, where you've got families where, it was fine living in 1,200 square feet with four kids, as long as the kids were all out at practice and everything else. But if you're not doing that, everyone's bursting at the seams. So Justin, and then Marshall, you can follow.
Yeah, a lot has to do with just what the life plan is. If it's a good time to buy or sell. I mean, it's a good time to buy if you're buying for the long term. You lock in a great rate, and you have some patience through a transaction that might have a couple of speed bumps, like we talked about. Certain things are going to come up. They always do, even in a market that is a lot healthier than this one. So you just have to be a little more patient. But there also, what I'm seeing is an emerging trend with buyers who favor home offices and privacy from neighbors and a space for exercising and even like growing herbs and vegetables. We didn't see this pre-COVID as much. So on the seller side, those who can position their homes with this in mind, I think we'll see a real increased demand. And it's a good time for sellers to sell also. If they have a plan and get unfiltered professional guidance from a realtor who really knows how to navigate these challenging markets. And with the first-time home buyers, it's just about being prepared with everything. It's first-time home buyers being prepared, realtors being prepared, all the mortgage professionals being prepared, people just working to the benefit of whoever they're trying to help. And with sellers really should be clear on why they're selling. It's not about chasing a market anymore. It's do they maybe want to move out of a less populated area, or does their current home suffer from some sort of functional obsolescence? Maybe they want to be closer to relatives. Also, pricing a home is critical now for sellers, now more than really ever, because buyers are going to be a little more reluctant to chase the market up if the overall demand isn't there. So it's important to remember as a seller, even if you don't get the same price as maybe you could have 6 months ago, when you become that buyer, you're still getting an advantage in that same market. So hopefully that information helps.
Definitely. Marshall?
Yeah, I agree with so much of what Justin said. I think that if you're a first-time buyer, and I'm working with people like that right now, the key is being prepared. So if you've been preparing financially, keeping your debt in check, keeping your credit scores high, you can really take advantage of low interest rates right now and get into more home than maybe you thought you could get. The challenge, at least in the Dallas area, is when you step out and go look for that home, you will find a lot of company, a lot of people looking for that same house. It's going to be pretty competitive. So be ready to move quickly to make an offer. When you see a home, you really just can't sit and think about it. You need to move quite quickly. But for folks that are maybe getting to their second home and upgrading and working with folks like that they may have a home to sell. Well, it's a great time in the Dallas market to be putting a home on the market because you have a lot less competition than you would have this time of year. So you may be able to get maybe a bit of a premium, who knows, for your home because of this. So it might be a good time to put your home on the market and be able to get into that next home. So really for anyone in any situation to take advantage of those rates that we see in mortgage right now is good. But knowing that the market's not reacting normally right now, and you just have to bob and weave as you can.
Excellent. And, I think this is a good time, Cherie, why don't you talk about, so for those that are homeowners, right? So these are folks, let's say you've had your position where you're furloughed and it's just, you're not able to make the mortgage payment. Talk a little bit about mortgage relief and what options are available. How does that impact your credit? Does it impact your credit? Can you get it refied in the future? Can you buy a home after all this? All of those different pieces.
So with respect to forbearances, which I think it's absolute must for people that have lost their jobs or their income has been impacted, it's a great option. And the forbearance can last, under the CARES Act, the forbearance can last for up to 12 months. What you'll find with some servicers is that you'll start out with 3 months. And then after that, when that 3 months is coming up, they may say, do you need another month? Every servicer is probably doing it differently, but the law says that you can have a forbearance up to 12 months if you need it. And hopefully people are utilizing it that actually need it. It's supposed to be, and you have to affirm this if you call in for it. They're not going to go through the eligibility like documents and all of that, but you have to affirm that this forbearance that you're seeking is due to the COVID-19 impacts. Somehow you're impacted. If you're sick, or if a loved one is sick, or your income has been impacted, or you've been laid off, you have to affirm that. And like I said, it can last up to 12 months. And what's happening during that time is it's a pause. And after that 12 months, what some people have heard, and so there's a little confusion, and we're working really hard. I know our company is, I know all companies are that are in the servicing business. When people hear you have to pay it back, after the forbearance is over, you have to pay it back. People are like, wait a minute, I can't pay back 3 whole months. Don't you see what situation I'm in? And it's not that you have to pay it back immediately. That is an option. You can do a lump sum payment. You can also, another option is a repayment plan where the amount that has accumulated over that time during that pause can be spread out so that your mortgage payment can be a little higher going forward. If now you've gotten on your feet or your job has restarted, you can also have a loan modification where there's an adjustment in some of the, whether it be the time of the loan, the length of the loan, or the interest rate. So that's almost like a brand new loan when you modify the loan to help, depending on what your situation is at that point. And then just yesterday, Fannie and Freddie came out with being able to have a deferment or deferral and putting the payment on the back so that it's only due once you sell the home, it matures, or you refinance. So, and that's going to begin the beginning of July 1. I don't know what's going to happen in the interim, but starting July 1, that'll be one of the options as well. But the servicer is going to go through, whichever servicer you have, they will go through all those different options just to make sure that the right one is selected for you. And like Ron said at the beginning, it's not forgiveness. I think some people thought, all right, I don't have to pay my mortgage, but it's not forgiveness. It is a forbearance. It's a pause and it's a stop. And just to give you all an idea of where we are, I looked up some of the stats that are letting us know where we are with respect to forbearance, and 7.9, so almost 8% of all loans that are in portfolios are on forbearance at this point in time. And there have been 4 million forbearance requests out there. And so that represents 890 billion, I'm making sure I say it right, 890 billion in unpaid principal. And so going back to the servicer versus who owns the loan, servicers are advancing. I know Fannie and Freddie have put a cap. It's 4 months that the servicer has to advance, and then they'll stop it. But that's only, those government-backed loans. There are also private loans, and so people really need to reach out to their mortgage company and their servicer to find out what are the options, what can be done for them at that point. So.
Excellent. Really appreciate that. And just to piggyback on that a little bit, if somebody, if they're in the process of forbearance and they get out of it, if you're trying to buy a new home or you're trying to refinance, you may have to wait, right? So there's guidance that's coming out that says if you've gone through the process of a home loan and even though on the credit report it's not affecting your score, it still shows up, right? So it'll still show forbearance, and underwriters are scrutinizing that. So again, it's meant as a last resort. It's not a financially savvy good decision. It's just really reserved for those where it's a last resort compared to foreclosure. So back to, I'm going to start with Marshall. And I think one of you, either Justin or Marshall, you were touching on it. You were talking about home offices, right? So, I'm in one of my bedrooms at home, and it'd be awesome to have this great green screen and soundproof so the dogs aren't barking and everything else. So, what are you seeing in terms of trends that are coming out with new real estate and where things are going from a residential standpoint post-COVID?
Yeah, I think there's two trends, inside and outside of the home. Outside the home, I'm seeing continuation of the trend for better, more extravagant out living areas with pools, places to cook, eat. During much of this pandemic in Dallas, the weather's been beautiful, so people have just been eating outside and staying outside more than they ever did before. So they're really aware that their backyard might not be in good shape. So they're saying, well, it'd be easier to go buy a home with a pool. And so you're seeing a continuation of that that's been very, very popular in this market, but more so. But then inside, we're seeing people want more rooms and more space to do different things they ever imagined they'd be doing, like working from home permanently, having to be video where you don't have a bunch of boxes and toys behind you when you have to go on your Zoom call. So they definitely are wanting places that are quiet that they can work and be on a Zoom call, things that they never imagined before, for sure. And then the other thing we're seeing is workout rooms, with gyms being kind of suspect places in some people's minds. They want to be able to work out at home and have home gyms, whether that be an extra space in the garage, an extra room. We don't really have basements in Dallas, but I know out east, definitely basements have always been an option for something like that. But in Dallas, we don't have that, so you have to have a room built, and we're definitely seeing that.
How about in Southern California, Justin?
I think Marshall really covered it. I mean, we don't have basements here either. So, yeah, it's just being able, I kind of mentioned a little bit about it before, but what I'm seeing is kind of this trend that didn't happen pre-COVID, where people have had difficulty getting food and didn't want to necessarily go to the grocery store. So it's, how do we potentially have our own herb and vegetable garden, grow some fruit, so we can be in our own world at our home and not have to rely on going to the grocery store as much. And having, like Marshall said, all that exercise space, being able to feel like there's outdoor space and not have to go to a park to be able to facilitate that, and being able to bring family together under one roof, as long as you have the space to do it, I think is something that has come up a lot in recent conversations as well. So we're just, it's a changing time. People are evaluating what's important to them, not just in the home buying or home selling or home ownership, but also just in how they want to live their lives. And I think it really shows that we have the ability as people to reevaluate in times of stress and understand that sometimes these stress points can bring about real positive change. And it'll be interesting to see what happens. It'd be interesting to do a call like this again in 6 months and seeing, what are the new trends that really pop up, because some are really going to take hold for the future.
Yeah, absolutely. And, Justin, you mentioned earlier a little bit about the home buying season and how it was going to be pushed till the fall. So if your client wants to maximize their investment in terms of what they're going to receive in terms of proceeds, as well as have the most amount of eyeballs and demand for their particular home, what are you advising them?
I'm advising them to focus on realtors who really understand challenging markets, because those realtors have seen a lot of things before. So they've been able to test in real life what has worked and what hasn't, and taking advantage of technology. I mean, that's probably the biggest thing. If we can do the virtual tours and do the virtual staging also, rather than having to, disrupt someone's home living situation and bring in furniture, virtual staging has come a long way in its technology, and it's incredibly valuable right now. And
Justin, we may have lost you there.
they're going to,
Oh,
can you hear me?
okay, now we can hear you. Yeah, we lost you there for a second.
Oh, yeah.
Virtual staging is what you were saying.
Yeah, digital staging is going to become stronger than ever, and homes that are in better condition cosmetically will have a better foothold, because if buyers aren't going into the homes as much and are relying on the virtual tours, those homes are going to get more eyeballs and therefore get more offers. The homes that need a lot of work, it's going to be tougher. It's going to be a lot tougher to move those unless the price is really right relative to the condition of properties.
Yeah, Marshall.
Your question?
No, it's beautiful. And, Marshall, we were talking about this yesterday. So if you think about it, if you're a homeowner and, the traditional model is you put your home on the MLS, the builder, they bring in a crew, take pictures, you put it on MLS, and then you hold a bunch of open houses. Well, behind the scenes, you have clients, if they're living in the home, right? So that's the big caveat. If they're living in the home, every time you hold an open house, they have to leave, right? Because you don't want the homeowners being in the house, right? So you have evening events, so twilight open houses, you have weekend open houses, then you have broker opens, and then on top of that, you have individual buyer appointments. So in this environment, my wife and I we're currently renting, and if the rental office, leasing office says, okay, we love your layout and we want to have people come in to check it out. No way. No way we would allow people just to come in and we don't know where they came from, right? So I think that's it, my personal opinion. I think it's going to be a challenge to do open houses in the future. But I do see a trend with doing the Matterport, like we talked about with the Malibu home and getting your home show ready. And you have all these tools where people can go through the tours on their own, at their own time, all online, safety, the whole thing, and not interrupt people's lives if they're living there. So, what are your thoughts about that?
Yeah, no, I agree. And I think there's certainly going to be clients that don't want all that traffic in their homes for whatever reason. And so finding the tools to use to market their home properly and most effectively in that sort of case where, hey, I don't want anyone to come in my home until they have a contract. It's possible, but you have to really be creative and find the tools to market their home successfully to get all those eyeballs to see that home and be interested in making a sight unseen offer. A lot of buyers aren't really comfortable with that yet. And honestly, a lot of sellers aren't comfortable with that yet. It's pretty risky for them to put a contract on a home and take it off the market for someone who's never even seen it until they show up the first time and they go, oh, I really don't like this. And then they just wasted a week. So I think there's definitely some mindset change that'll have to happen. But for the sellers who that's the only way they can sell their house, that is an option. And I think that even though as a realtor, we don't really like this as much, but it gives an opportunity for the iBuyers like Open Door, Zillow to come in, and because they can make an offer, and many times that is almost a no contact type transaction where they might have an inspector or someone come in and look at the home, then that's it. After that, you set a closing date and you're done. So that might be more appealing to people who just want out of their house and don't want to deal with the risk of selling, is for when Zillow and Open Door and people like that get back in the market in force, they could see some of those sellers coming their way because of the risk.
Yeah, that's a good point. If you've got a home, let's say it's an investment property, so you have a rental property and the tenant is already out, and you're able to just now have that home completely open, but nobody's living there. So you don't have that risk of who's coming in my house and all that because you're not even living there, right? So you're not as concerned from a health perspective. And I think in that model, it would work where you could have in a vacation home or an investment property where you have a traditional open house. But again, if you're not spending all your time at open houses and buyer appointments, you could be really helping a lot more people. And on top of that, given that there's such low inventory and there is demand, right? So there's that pent up demand by buyers that are taking advantage of the low rates. And the government has, the Fed has actually said that they're going to keep interest rates low for a good amount of time. Because if you think about it, they're not going to raise rates in this environment. They're trying to kickstart the economy. They want growth. So they're not going to, again, my crystal ball is fuzzy at best, but I don't see the Fed raising rates anytime soon. And I see a real nice runway where you've got nice low rates for some time. So Justin, tell us a little bit about how you're preparing your buyers with this climate. They may have dipped their toe in the water and started the pre-approval process. But if they haven't gone through what we've been experiencing this year, what's changed? So, how are you preparing your buyers for this new climate if they want to go out and go buy a property and make an offer?
It's to come from a place of patience first, because there are going to be a few hiccups along the way. And so, and just have all your ducks in a row from a financial standpoint, and understanding what your true purchasing power is. It might have been different 6 months ago. If you were a buyer that had a lot of your funds that you were going to use as a down payment tied to the growth in the stock market, well, potentially all those funds have evaporated. So it's just being a little stronger financially, having more than one source to fund. And that's going to get you, of course, a stronger loan program and put you in better position with a seller against the competition. And the rest is having, partnering up with a realtor who can give you the raw data on the market, and to understand, even though we're in an unknown time, there's still some educated guesses on where the market is going within each submarket, and it really depends, state to state and city to city. So it's really understanding, do I want to be in this market? What will that cost me versus another one? And do those specific properties, do they fit my wants and needs list as well?
A good point. And, Marshall, you and I, we talked about this a little bit yesterday about luxury buyers, right? So luxury buyers in at least in Texas and Dallas, we're right about, 750 plus. That's a starter home in California, and especially in Southern California and key markets.
True story.
True story. Absolutely. But if you think about luxury buyers, these are people that are they typically have jumbo loans. They also are financially savvy. And what I've found in my experience is if their investments are impaired or their business is down, they don't feel wealthy and they're not going to buy. And it doesn't surprise me that the statistic you talked about in Park Cities area where the actual home prices are down by 30%. It's also down in cities like New York, right? So, from a buyer's perspective, knowing that there is a 3% mortgage rate that's out there, and their current mortgage rate might be 4.5% or 5%. Now there's that window of opportunity. So, Marshall, why don't you talk a little bit about where you've got that opportunity to trade up, kind of what we were talking about yesterday, and then we're going to open it up for Q&A.
Yeah, the luxury market's going to be a little bit different for sure in this environment. I had a buyer back out just because they had a bad experience on a conference call at work. They just didn't feel confident. They had the money. That wasn't the problem. They just didn't feel comfortable. And so they don't have to move sometimes. They just want to move or they see something they like. So it's a little bit different market. And with jumbo loans not being available or being more expensive or having to cobble some sort of financing together that could be pretty expensive. I think a lot of the luxury buyers are waiting, but if you're a cash luxury buyer, boy, and there's some inventory on the ground, you could maybe make a deal because it's definitely not as many buyers out there in the luxury market. And for people with a lot of equity coming out of their homes that they're selling to buy, it might be an opportunity to maybe think about buying a luxury home if they have a lot of equity and maybe don't need a jumbo loan. Could be a great opportunity.
Absolutely, absolutely. Well, fantastic. So we've got some questions here. So we have one from George. George Cheerswat. So George, sorry if I butcher your name. My apologies, George. But George says, do you see sellers adjusting? I got it. Thanks. Do you see sellers adjusting prices to account for new affordability as a result of lower rates?
Not right now. And this of course depends on the market. As Ron, you had mentioned, and Marshall, you just discussed, price points matter. So I haven't seen it at all. I don't see, like I said, a pandemic discount at all. That could happen. It's possible. We haven't seen the full effects of what's going to happen because of the financial support through different means. But ultimately, we're at a major supply shortage, and that is the most critical factor in what's driven the market nationally. That hasn't changed. We are still at that shortage. So it's a better way to probably think about it is how, as a buyer, you can add value to that home you move into, whether it's a cosmetic renovation or buying in distance to a school that is going to have a lot of people long-term that are going to want to be in that school district, or on a street that is, easier to walk around in, or a better neighborhood. So it's more of kind of flipping it and thinking that way about it. I think is more important.
Got it. And then you talk about school districts. So, I asked Marshall to do a little bit of research here. So, traditionally the home buying, selling season, at least that I found in Texas, is, it starts really where you're starting to list homes in March and April. It really starts going in May, and then it abruptly ends right when school starts. But if people aren't going to school, right, because they have shelter in place and you can't go to the school, how does that impact the overall housing market?
Yeah, this is the big question mark, I think, in our business in Dallas right now, is what's going to happen to the schools, because normally the schools back in Texas go back in the middle of August. And so if you look at the calendar now, we have a very short season if that's going to happen, for people to buy and sell and get set up before they get started the next school year. The school systems, I think Allen is the only one who has said that there may not be school for the rest of this calendar year. None of the other districts, I think, have said they all have contingency A, B, C, and D plans set up yet, but they've not announced anything. If you start seeing school systems delay or maybe not have school for the rest of this year, then you could see a pretty big impact on the market, and all of a sudden our summer selling season just evaporate, and not as much of a rush to buy and sell. And so it could slow things down if we don't open back up schools in August.
Right. And then Justin, tell us a little bit about what's going on with LAUSD. Have they made any announcements?
I mean, the kids have been working. Kids have been going to school from home. So that's really what's been going on. I mean, a lot of the updates here have changed on a week by week basis, whether it's how we show homes or how kids are going to school. But I think at this point, parents have really shifted and becoming those at-home teachers, whether they've wanted to or not. But looks like the rest of the year will be canceled. And as far as when they start in the fall, or if they start before the fall, too early to tell right now.
Got it. Thank you. So we've got a question from one of our panelists. Cherie asks, question for Marshall and Justin. Do you think that sellers will consider renting more now if they do not want to allow folks in, or will they stick with selling?
As far as, I guess it really depends on what their financial profile plan is more than anything. there will be a lot of sellers who don't want people in their home. But, whether we're in this pandemic or not, life kind of moves forward at the pace the individuals need it to sometimes, and certain things can't wait, and they still have to make those buying and selling decisions and just work with the limitations that are existing in doing that right now. Did that
Excellent.
answer your question?
Just shaking her head, yes.
Okay.
All right, our friend George says, are there any new worries that buyers should be wary of as a result of a more virtual buying experience like inaccurate appraisals? Ooh, I think we all could say something about that, right?
Yes.
So George, really good question. So, so first of all, when it comes to an appraisal is a document that is designed and really it's for the benefit of the lender, right? Because it shows it's a document that it secures the property, right? So it is an instrument that lenders have that say, okay, this is what this particular home is worth at the time of the closing of this particular loan. And we agree that when Justin or Marshall, they sell a home, the sales price matches up and our interest is protected. So as far as it having an inaccuracy from an appraisal standpoint, what the appraisers do, so they don't just go to Zillow.com and do his estimate. What they do is they look at comps, right? So they'll look at comps in the area, so comparables. And they will see which homes have been on the market, typically within a 2-mile radius in the past 6 months, right? So that's and homes that look the same, right, as the home that we're talking about. So the subject property is what it's called. The subject property, let's say it's a condo, 2-bedroom, 2-bath. They're looking for other condos that are 2-bedroom, 2-bath and fit the same square footage and time and all of that. And then they have the adjustments that factor in with all of those things. As far as, if there have been any upgrades or there have been any sort of pieces that you wouldn't get just with market data, to protect that value and to make sure the homes come in at value, because if it comes in lower, then now you're getting into a situation where now you have to renegotiate with the buyer of what that home is really going to be sold for. So it's really in the best interest of the seller, the homeowner, to make sure that they do get the home and it comes in at value. So if they've done all those upgrades, they have that ability where they can send, not to me, right? So they can't send it to me. There's a wall in between a loan officer and an appraiser, but they can certainly communicate with the appraiser and send them, here's all the pictures, here's the big kitchen remodel, here's our bills that we paid as a result of upgrading $120,000. So those are things that help protect the appraisal. Justin or Marshall, you guys have any thoughts on that?
Yeah, exactly. Yeah, it's the seller's realtor can work pretty closely with that appraiser to make sure they understand the true value of the home. If there's been updates, remodels, any new roof or new AC or any features of the neighborhood that maybe they didn't pick up on that they would be aware of, making sure they have all the pictures and the tours of the homes. It's really the job of the realtor to make sure that that appraiser is seeing that home in the best light.
Yeah, you guys covered it.
Awesome. So we've got another question here, and George says thank you. So we did our job. So the question is, do you have any general thoughts on the viability of refinancing or tips on how to get the best rate at this time? Mark, I'm glad you asked that question. So when it comes to refis, it's a personal decision, right? So it's all about what the person wants to accomplish, right? So there's not a hard and fast rule where if 4.5 and the market rate's at 3.25, then you automatically have to go and refinance. That's not the case, right? If you've been making payments for 20 years and you don't want to restart the clock on a 30-year fix, might not make the most sense. But if you're hurting financially and by refining you're able to reduce your monthly payment and you don't care about, or you're less concerned about restarting that clock, then it may make sense, right? So our job as mortgage professionals is really to have a good understanding of what you're trying to achieve in terms of whatever your financial objectives are. And, sometimes I get in a situation where I'll look at a particular client and I'll just tell them, well, instead of refining to a 15-year fix where your rate's at, just a little bit lower than your 30, why don't you just accelerate your payments? Why don't you just make a bigger payment each month and you can reduce the amount of interest you're paying? And they're like, well, don't you want the refi? And I'm like, I'm providing advice, right? So it's really about helping that particular client make the good financial decisions. And coming from a wealth management background and having an MBA and all these things, it helps, right? So it helps with that overall analysis, and I like it. I like to teach. I like to help. Do we have any other questions? And Mark, I don't know if we want to open it where it's a Zoom party with all of the all the different squares here. Yeah, it's great seeing everybody.
Yeah, people could unmute themselves, and if they have a question, they could feel free to shout it out.
Yeah, so this could be the free-for-all. If anyone just has questions, we're here. Anybody?
Hey guys, this is Mark at Strandview Capital. Just quick question. I'd like to understand the sudden drop in negative rates a little bit more, and how that, the margin calls of the hedge has gone wrong, how that really kind of blew up the non-QM firms out there. If you could speak to that a little bit.
Yeah, so absolutely. So when it's come to non-QM, so 66% of the mortgages that are done in this country are Fannie and Freddie. They're in the conforming space. So the government has said we have to protect Fannie and Freddie. We have to protect FHA. We have to protect VA. So that's kind of the four groups, the four horsemen, right? So they want to make sure that that's all protected, because if you don't, then you get into a situation where you're really damaging the economy. When you're looking at non-QM loans, so non-qualified mortgages, and you get into portfolio loans, these are riskier, right? So they don't fit the conforming standard. So they're not based on Fannie and Freddie. It's really the appetite of the particular investor, right? So the investors behind it. And when markets are flowing freely, they feel comfortable lending because they know that, and some of this is called make sense lending, right? So if I'm an investor in the non-QM space and I have someone from France that wants to finance a home and put down 50%, well, provided that I've run their credit or done an international credit report and I know that they have X amount in assets in the bank, I'm going to do that deal because I know that I'm going to be compensated where I could do a short-term loan like a 5-1 ARM or a 7-1 ARM, and I know that they're going to make those mortgage payments, and I have priced my loan in terms of the interest rate accordingly where I've built into my safety net. Now, when you have a market that we have right now where there's been very little support on the non-QM side, and the government isn't stepping in and flushing the market with all of this cash, and all of the refis have already gone through, and there's been no support. A lot of those non-QM lenders, they just don't have capital. They can't do the loan, and they don't see the risk reward as beneficial, because if you're living in France and you've got a U.S. loan and you're having a tough time in France, it's much easier to walk away from your U.S. home than it is for your home in France, right? So that's really what's happened. As far as margin calls and all those other pieces, yeah, that certainly has happened. I think a lot of that has to do with the servicing. So I think there have been a lot of servicing companies that were over leveraged, and they weren't necessarily as well capitalized. Where if you're making those mortgage payments on behalf of your client, and if you set it up where it was only set up for a small percentage, not 8%, but maybe like 1%, where only a very small number of people would stop paying their mortgage, and you have it set up for maybe 2 months, that's where you get in trouble. That's really where you get in trouble. So I hope that answers your question.
It does. Thank you.
Thanks so much. This is super helpful. One quick question is that do you think for refinancing, the interest rates are going to go down even more in the upcoming months with unemployment reports or something? Or do you think this is pretty much as low as they're going to get?
Yeah, so great question. Again, it's a personal decision. I try not to market time anything, right? So when I lock a loan on a purchase, we go ahead, and when we make that decision, I always ask them, do you feel comfortable with this payment, right? So it's not a game. It's not, trying to win and get the absolute best rate possible and trying to, lock in at the absolute perfect time. It's not going to be possible to do that, right? So it's really a personal decision when it comes to looking at, is this a rate that I feel comfortable with? Because honestly, clients that I've helped, at first they're very concerned about the rate, and they're like, okay, is this a good rate? And but if I ask them 2 years into the future, they don't know what their rate is. They just know what their monthly payment is, right? So that's what's key. Now, as I mentioned in the very beginning, there are certain segments where you're going to have much lower rates compared to others, right? And the reason is because of what we were talking about with Mark, where you have the government that's providing all of this support and liquidity and buying mortgage-backed security, where it's really keeping the wheels going when it comes to home ownership and home purchases. And you're going to be compensated very well for that. A big reason why jumbo investors, in addition to not having, feeling wealthy, they also have backed out because there's a difference, right? So right now you're looking at a jumbo loan at $700,000 in Dallas with 20% down, with great credit, 780, about 4.25, right? So compared to 3.25 or 3.375 on the conforming side. So that's so I hope that helps a little bit with your question, Sarabi.
Thank you.
Okay, this is Mark again. Sorry, I have one more question, or maybe
Sure.
two. So, back in 2009, 2011, we saw a lot of foreign direct investment come in here, especially in Los Angeles. My wife and I were beat out by cash offers quite a bit. Do you see that foreign direct investment starting to flow back into the U.S., looking for distressed opportunities?
Was that for me?
Yeah, Justin, I think that's a good one for you.
Yeah.
No, I don't see foreign money coming back here right now. I think, a lot of the foreign money, I mean, depending what price point we're talking about, but in kind of the luxury market and ultra, so I would say, above 5 million, people were starting to kind of blink a little bit, and above 10 million, it was really slowing down. And I know these numbers might seem a little crazy if you're not in this market, but the over 10 million was moving pretty fast for a while, and a lot of that was foreign money. So a lot of the foreign money was starting to leave even before COVID struck, and I don't see it coming back right now, primarily because I think a lot of the foreign money is just waiting to see if we are, as a country, getting healthier and being able to manage the potential spikes. So I think it probably will make more sense for the foreign money to sit on the sidelines right now, because they don't have to be in an uber rush to make an investment in the U.S. So I don't see that foreign money coming back for a little while.
Great, thank you.
Any other questions? All right. Well, on behalf of all of our panelists, we really appreciate the opportunity. If you have any questions, Mark, you can put up the slide, or Jacob, with all of our contact information. Feel free to contact us directly. We would love to help. We're all alums together, and we'd love that opportunity to just have a chat with you. And if you have questions in the future, feel free to email those to us. You can submit it, any way you can get a hold of us. We'd love to chat. So appreciate the opportunity.
Thanks, everyone. Stay
We'll
safe.
send out the information for the slide deck that we had here.
Okay, perfect. Awesome. And I believe it's also been recorded, so you could share it with others if you'd like. Awesome. All right, everybody. Well, thank you so much. Everyone stay safe. Good seeing everybody.
Thank
Bye-bye.
you.
Thanks.
Thanks, guys.